1 week ago, Elon Musk became the world's first trillionaire, not because SpaceX invented anything new last week, not because revenue doubled, not because the company turned a profit. It didn't. SpaceX lost $4.94 billion last year. He became a trillionaire because the rules changed. 3 rules. Rules that existed for decades. Rules designed specifically to protect people like you from what was about to happen. This is the story of what those rules were, who changed them, and why every retail investor who bought SpaceX stock last Friday just became exit liquidity for the insiders who wrote them. On April 30th, S&P Dow Jones Indices opened what it called, and I'm reading from the actual document, a consultation on the treatment of mega-cap companies. 3 questions. Should we eliminate the profitability requirement? Should we cut the seasoning period? Should we waive the minimum float requirement, the rule that makes sure at least 10% of a company's shares are actually trading? Now, you need to understand something about timing. SpaceX had already filed its S1. The IPO was scheduled for June 12th. The consultation closed May 28th. If the rules changed, they'd take effect June 8th, 4 days before SpaceX began trading. The consultation window was 28 days. For rules untouched in more than 2 decades. For an IPO that would raise $75 billion. Nobody talks about this. Nobody asks why the window was exactly long enough for SpaceX and exactly too short for anyone to mount real opposition. Let me show you what these 3 rules actually protect. Rule 1. The profitability test. To join the S&P 500, a company must be profitable in its most recent quarter and for the sum of its 4 most recent quarters. This rule kept Tesla out until December 2020. Tesla was already one of the most valuable companies on Earth. The committee said no. SpaceX lost $4.94 billion last year, $41.3 billion in accumulated losses since founding. This rule exists so a company at 110 times revenue doesn't get forced into your 401k at an insane valuation. Rule 2. The seasoning period. 12 months. Lets volatility from a new IPO burn off before trillions of dollars of passive index money are forced to chase it. SpaceX wanted it cut to 6 months, just inside the window. Rule 3 is the one that matters most. SpaceX floated approximately 5% of its shares. 5%. The other 95% remain under lockup. To get into the Nasdaq 100 or S&P 500, index funds have to buy. They have no choice. Trillions in Vanguard and BlackRock funds forced to purchase whatever shares exist, and what exists is 5% of a company valued at $1.75 trillion. Goldman Sachs estimates the forced buying at $60 billion. $60 billion, chasing 5% of shares. Who do you think sells into that? On June 4th, 8 days before the IPO, S&P Global announced its decision. They said no. The consultation produced no changes. Profitability still matters. Seasoning still matters. SpaceX will not be eligible for the S&P 500 until at least mid-2027, and only if it posts 4 quarters of positive GAAP earnings. But here's what nobody is connecting, and this is where it gets malicious. The Nasdaq had already changed its rules. In March, Nasdaq adopted a fast entry rule. SpaceX enters the Nasdaq 100 after 15 trading days, not 3 months. FTSE Russell went further, 5 trading sessions. 5. Nell Minow, a corporate governance expert who's been fighting these fights for decades, said it outright. Quote,
they're shoving it into the index, even though it doesn't meet any of the normal requirements and qualifications for getting into the Nasdaq index. And unlike the U2 album, you can't erase it. You know, the pickle that comes with your hamburger, they're making you eat it. And that's what bothers me. If they thought that this was a real viable stock, they would not be taking all these end runs to the free market.
They had to bend the rules to get into the Nasdaq index. They would never qualify normally. And an index is supposed to say, "We will do the work for you. We will only put into the index companies that meet these specific qualifications," and then they're sneaking some in. That's an expert on corporate governance calling it what it is. Let's talk about who gets to sell and when. Standard IPO lockup, 180 days, 6 months. Insiders can't sell. SpaceX designed a staggered lockup. Insiders, not Musk but the people around him, can sell in increments. 7% after 70 days, then more at 90 days, more at 105. By the time the standard 6-month lockup would expire, SpaceX insiders have already sold 35% of their shares. And here's the thing, when index funds come in, when that $60 billion in forced buying hits, there are only 2 sources of shares, the company itself and insiders, free to sell into your demand. Fidelity lowered its account minimum for this IPO from $500,000 to $2,000. Specifically for this IPO.
The lockup structure tells you exactly who this was built for, not you, not the retail investors Fidelity dropped its minimums for. It was built for the people who already own SpaceX shares, the people who get to sell into a flood of forced index fund buying while you're hoping the stock goes up. Now let's talk about the numbers, because this is where it comes apart. SpaceX generated $18.67 billion in revenue in 2025. The IPO valued the company at $1.75 trillion. That's a price-to-sales ratio of 96. No company at the forefront of a game-changing technology for more than 30 years has sustained a PS ratio above 30. SpaceX debuted at 96. More than triple what history says is sustainable. But there's more. SpaceX acquired XI in February, Musk's AI startup. The prospectus cited a $28.5 trillion total addressable market for the AI business. Aswath Damodaran, the Dean of Valuation at NYU, looked at that number. His word? Hallucination. XAI's actual first quarter revenue, $818 million. Growth rate, 12.5%. That is not a growth story. That's a flatlining business being sold as the future of AI. So let me summarize. A company that lost nearly $5 billion last year, a revenue multiple 3 times higher than any sustainable comparison in history. An AI division growing at 12%. A TAM described by the world's foremost valuation expert as a hallucination. And the Nasdaq said, "Come on in, 15 days, we'll make room." That's not a market, that's a transfer of wealth. June 12th, SpaceX opens at $150 a share, closes at $161, up 19%. Post-market climbs to 166. Market cap, $2.2 trillion. Jim Chanos, the legendary short seller who predicted Enron, calls it a troubling sign for the broader markets. Retail traders celebrate. They bought in, they're up. But here's what they don't see yet. August, the first insider unlock. November, the second earnings report. By May of next year, when the forced buying has happened and the hype has settled, insiders will have sold billions into the demand the rules created, and retail investors who bought on opening day, the rules were changed for this IPO. The lockup was designed for insiders to sell. The valuation doesn't work, and nobody asked you. This isn't just about SpaceX, it's about Anthropic, which filed for IPO the same week. It's about OpenAI, rumored to go public next quarter. Neither is profitable. Both will want the same rule changes. Both will structure the same staggered lockups. Both will sell the same story. The S&P 500 committee held the line this time, but the Nasdaq didn't. FTSE Russell didn't. And the competition among exchanges for listings means the rules will keep bending, the rules that were supposed to protect you. Here's the document I'm holding. The S&P consultation on megacap treatment. The proposal to eliminate profitability requirements, to cut seasoning periods, to waive float minimums. It exists. It was considered. It was closed 4 days before the SpaceX IPO. The question isn't whether the system is rigged. The question is who rigged it. And why does nobody talk about it?